Good morning. I'm Sharon Douglas, owner of Pateri Construction and your host for Things You Need to Know. If you'll give me an opportunity, I'd like to share some things with you regarding my history, and we're going to call this Lessons Learned Through the Eyes of a DBE. Years ago when I started my business, I didn't know all the details to what it took to run the business from an accounting process. So what happened? I got myself in trouble. And what's the purpose of me being here? My purpose is to help you. So today, we're going to cover the accounting process. But I have a special guest here today, Craig Driesner, CPA for Driesner Services. Craig is going to help us understand the accounting processes. Craig, my first question is, what does the back room look like? How do you start that up?
Well, Sharon, thank you for having me on. The first thing you kind of need to do is figure out how the entity is going to be taxed. I mean, you're starting this company, and you're doing it to make income. Well, how's that income taxed? There's several different types of entities. You can either set it up as your individual with no company name and it just be your name. You can do a DBA or a doing business as name, or you could select what to incorporate, whether that's an LLC or an Inc, an incorporation. Um, the individual, the DBA, the single member LLCs are all defaulted to a Schedule C, which is on your personal 1040, subject to self-employment tax, which is that extra bonus tax you get to pay of 15.3% on top of your income tax.
Oh, okay.
Then you have the multi-member LLCs. And a multi-member LLC is just the same thing as a partnership. You have more than one owner. Now, a husband and wife can be treated as a single member LLC on one Schedule C, or you can elect to to treat it as an S corp. The multi-member LLC automatically defaults to a partnership return, which is also subject to self-employment, except now instead of on a Schedule C, it's on a Schedule E on your personal return, and that income's flow through, just like mailbox money or rental on a rental house you own, or royalties. You're paying tax on the income that the business makes at your individual rate, but with a partnership, it's still subject to self-employment.
Okay.
You've got an S corp. You can choose to make an election to choose to be treated as a subchapter S corporation, which is similar to a partnership in that the income for the owners flows from the business to the owner's personal returns or shareholders' personal returns and taxed at their tax rate. But subchapter S election is not subject to self-employment. So it's just your tax rate. The thing with the S corp is then the IRS requires you to become an employee of the corporation and pay yourself wages, your W-2 wages, or you can incorporate. And the Inc is defaulted to a Form 1120. Now the corporation will then pay tax on its income, separate from the owners.
Now I do have a question there, Craig. What is that sole member? What does that mean?
Well, that just means that there's one owner. So for instance, if I'm listed as the owner on Driesner Services, it's a single member LLC. But if it's, for instance, let's say that my sister was also a CPA, and Courtney Driesner and Craig Driesner are both owners. We're not married because we're brother and sister, or it can be unrelated owners. At the time in which there's more than one owner, the default automatically makes the tax treatment of the income for Driesner Services into a partnership. because my sister and I would be partnering. It'd be the same thing, with you as a owner taking, if you're not the only owner and you have multiple owners, that's a multi-member LLC. Single member LLC is one owner, and that defaults to a Schedule C.
Understood. Now, the next question, talk to us about a balance sheet.
Well, Sharon, I want to kind of hold you off there because there was one thing that I was kind of getting to, but hadn't got to yet. When you select to be treated as a Form 1120, where the company pays income tax on the company's income. So that would go from the company's checking account to the Department of Treasury.
Okay.
If you decide to do that, you typically would get a little bit lower tax rate. But if the company then makes payments to the owners, those are dividends subject to dividends tax. So, that's where that whole double taxation comes in. And I'm glad you asked about a balance sheet, because a balance sheet is a snapshot. It's like taking a picture of the company. And the balance sheet has a certain structure. You start off with the assets, then you have liabilities and stockholders' equity. And the reason it's called a balance sheet is because both sides have to balance. You have the assets on one side, and then you have the liabilities and stockholders' equity. It has to balance. It's called a balance sheet for a reason. If you have, or the first thing on the assets is an asset is something that you can use to turn into cash and make money from, right?
Yes.
So, for instance, a bank account, that's an asset because you have cash in the bank account. A vehicle, say the company purchases a vehicle or a track loader or excavator. Those are assets because you're going to use that asset to make income and to turn it into revenue. Accounts receivable, meaning you sent somebody a bill for work that you completed because you want to be paid for it. Until it is received, it's an accounts receivable. Liabilities, on the other hand, you have the other side of the equation is liabilities and stockholders' equity. The liability is money owed by the business. So if the business, say you go down and pick up a bag of concrete that you don't pay for now, and you're expected to pay in 30 days, you have an accounts payable of the cost of that concrete.
Okay.
Or whatever you bought. That's a liability until it's paid.
Got a question, Craig, concerning the liability. You don't want those liabilities to get so out of range, right?
Yes, you got to be careful, with your liabilities, and you got to watch that. And it just depends on your situation too. You don't want to over leverage yourself, but you want to make sure that you have enough, because you want to make sure you have enough operating capital to continue operation. Cash is king.
Yes.
If you can't manage your cash flow, your business is not gonna survive.
Thank you.
So you want to, yes, you want to make sure that your liabilities don't get out of control. Um, then the third part of the balance sheet is the stockholders' equity or the owner's equity. Uh, that is the amount that's contributed to the business. So when the business starts, let's say, I put $10,000 into my business, my equity starts off at $10,000. And on the other side, you have cash of $10,000. So the balance sheet balances. Does that make sense?
Yes,
But
Dad.
then if I go out and buy a $100,000 excavator and promise to pay it, I have an asset $100,000, and then I have on the other side of the equation, I have the liability for $100,000, and so it still balances. Now we're at $110,000 between what I put in and the liabilities on the liabilities and equity side, and then the assets. I have $10,000 in cash, and I have $100,000 piece of equipment,
Okay.
and so it balances.
Okay. So that's a lot involvement with the balance sheet, and eventually we're going to come back around to that sometime later to make sure that our audience understood and that we assist them in getting their balance sheet set up correctly. Okay, Craig, let's talk about cost of goods sold.
I'm glad that you're addressing that one. A lot of people, they think that, I make income and that's my revenue and what I'm billing, and that everything's an expense. There are two types of expenses. There's an indirect and then there's direct. Direct expenses are cost of goods sold. Direct expenses and cost of goods sold, they're what you absolutely have to have in order to create the revenue. So, for instance, if you are pouring a slab or a driveway, right? The concrete that you use for that driveway is a direct cost. So, that is a cost of goods sold. The worker that is out there working that concrete and finishing it out, that is a direct cost because he is directly working on what you're making revenue off of, right? You're going to bill $10,000 for this thing. You want the revenues to, or the expenses to match. Well, an indirect expense would be your receptionist back at your office, your salary.
Okay.
Um,
Okay.
if you have an accountant, their salary, because they're not out there actually doing the work.
Right.
Their cost is not required to
For that
make
production.
that production. There you
That
go.
production.
So cost of goods sold is any cost that is directly related to the production of income.
Understood. Thanks for that answer. Now, let's talk about 941s. Let me give you a real short story. Years ago, I got in trouble with 941s, but I've learned so much since then. So, Craig, why don't you talk to us about 941s? What are they, and how do they impact the business?
Well, the liabilities created by one that's not paid is very dangerous, as you well know. the The reason it's dangerous is because if you don't pay it, the IRS is cracking down and putting a lot of people in jail for 941 liabilities. What a 941 is it's the employer's quarterly tax return.
Okay.
And there's also a 944, but most of the companies aren't going to have that, because it's only for liabilities of less than $2,500. And if you have anybody that makes any sort of, if you pay them anything at all, you're not going to fill out a 944. So you're going to be filling out a 941, which are due quarterly, because you've got Q1, which is January through March, Q2 is April through June, but let's just, and then so on. Q1, the end of the quarter is March 31st. The return is due no later than April 30th. And it's the last day of the month following the quarter. So the fourth quarter, for instance, is October 1 to December 31 of whatever year.
Okay.
But the return is not due until January 31st of the following year. That's the one that's always kind of confusing to people. When you're starting a new business and you hire employees, your employee is going to fill out a W-4, which tells you how much to withhold for federal income tax. The company is going to pay 7.65% of the wages paid to this person in Medicare and Social Security. You're going to withhold 7.65% of their income
Right.
from the employee's wages. So if they make $10 an hour, you've got 7.65% that the company will have to pay on top of that $10 an hour, but the employee's not going to get 7.65%. So their net check, and so we're just going to say nice round numbers to keep it simple. I like to kiss it. Keep it simple, stupid.
Right.
And that's the way we're going to pay them $10 an hour. We're going to withhold $2 an hour for uh, federal income tax, and we're going to withhold 50 cents for, which is not correct, but or 75 cents, and we'll withhold 175 for federal income tax. So you're basically going to pay this person $7.50 in cash, but you're actually paying them $10. And the company, but see, the company's total liability or total expense is $10.50, because remember that 50 cents for Medicare and Social Security that the company is matching.
Yes.
All right. The 941 is what reports this. So you report this person, $10 of wages, and then you report it has all the stuff on there that they're going to want to know. They're going to want to know how many employees were on the 12th of one of the months in the quarters. I think it's the first month or the third month in a quarter. You've got the gross total wages. You have how much is withheld for federal income tax, and you have the total Social Security, and then you have the total Medicare wages, and then you have the multiplier. But see, the multiplier for Social Security, it's 6.2%.
Yes.
So 6.2% times 2 is 12.4, right? So that's what the company's paying, is 12.4% of that income. So, basically at the end of the day, the company is liable for $3. In that previous example, we basically paid $10 in wages, withheld $2.50. $2 was for federal income tax, 50 cents was withheld for Medicare and Social Security. Then the company's going to match 50 cents. It doesn't exactly work out like, the math didn't.
Okay, and I understand everything that you've gone through. Now, one thing I want to say to our audience is, as Craig is talking to you about this, you have to consider that when you're doing your bidding process, because you've got to have that money to pay your taxes, and you've got to put that into your bid so it's not coming out of your pocket. Okay, Craig, can we move to the next question?
And Sharon, that's a great point. You definitely don't want to consider the net payroll all of your costs, because you definitely want the loaded rate, which is the employee's rate plus the company match portion. So it's good to mention, though, on the 941s, the federal tax deposit, which is the balance that's due from the company to the IRS. There's a portion of that was withheld. So then the company, it becomes trust, right? The company becomes trust because you're holding money that you withheld from your employees to pay the government, because the government and the U.S. Treasury is going to give them credit as if they had paid the U.S. Treasury directly. But you're holding that money, so they have a deposit schedule. When you start a new business, you are always on a monthly deposit.
Okay.
So, for instance, if you paid $10 in wages in January, the tax due, the $3 in federal tax deposit, which was $2.50 withheld and 50 cents company match portion, that is due on the 15th of February, by the 15th of the following month. If it's semi-weekly, and you pay on a Friday, the tax deposit then will be due the following Wednesday.
Right.
And then,
Okay.
once you
That
go to, and that's where the IRS is going to tell you what your depositing schedule is going to be.
okay, that makes sense. That makes a lot of sense because as I remember the problem I got into, I had a CPA that said to me I didn't have to pay it but every quarter. And next thing I knew, I was in trouble with the IRS saying, why are you not paying your taxes? You paid your employee and you're not paying us. So the answer to that, you
Deepest penalties.
that's correct. So that audience, you heard this loud and clear. 941s could get you in some serious trouble with the IRS. So again, you pay your employees on a Friday and you pay your taxes by that Wednesday of the next week.
Even if you're a monthly depositor, that is the best way to stay out of trouble.
Yes, I
That
agree.
is the absolute best way to stay out of trouble.
I
If you can't afford the tax deposit, don't make payroll.
Exactly. That's what I was told. Now, Craig, what about the franchise tax? What are
Franchise tax is a uh, state income tax, and in Texas we call it a franchise tax. It's also, I mean, it's a margin tax. So what it does is it looks at the gross receipts. That's all income for the company.
Okay.
And then you're taxed based on that. There is a threshold for a no tax due report. Uh, and then you've got the easy computation, which is 0.575 of a percent of the gross receipts. Or you've got the long form, which is gross receipts minus either the higher of cost of goods sold, labor, or another. It, I think there's three things, and two of them I know for sure is cost of goods sold and labor. Whichever one of those is higher and yields the lowest taxable number, if you have to fill out a long form, is what you'll pay tax on.
Okay. Now,
Now, each state's different too. So, for instance, if you're in Florida, Florida has a corporate income tax, totally different. It's global at that point. What if your company's in Florida, what it makes in all the states times an apportionment factor is what they paid the tax on.
okay.
In Texas, if your income is and you work in Texas, and that's where most of your nexus is, but then you do some work in Oklahoma or Louisiana, basically out of state, the gross receipts from the out of state stuff is excluded from the Texas as far as franchise tax.
Okay. All right. Good information. Good information. Now, what about the commission, the Texas Commission, Workforce Commission? What is it?
That's unemployment. You have state and you have federal unemployment. The federal unemployment, which is an annual form, it goes to the IRS. It's a form 940, just reports the gross wages and basically each person's subject to up to $42 of their first $7,000 in taxable wages. The state, which is in Texas, is the Texas Workforce Commission. They're the ones that regulate unemployment. That's where you go to file an unemployment claim, but as an employer, you will have to report to them, and it's reported quarterly. And that form is a Texas Form C3.
Okay.
What you report to them is you report and pay tax at whatever rate they establish. You start off at 2.7%, and then they go based on what's called experience rating. And so as you get on down the road a little ways, you will get a better experience rating if you have less unemployment claims.
Okay.
So if you have relatively few or no unemployment claims after, a couple of years, they're going to come back and say, wait a minute, you don't need to be paying in 2.7% because you've already paid in. And so we're going to drop you down to, I think the lowest is like 0.51 right now, 0.51%.
Okay.
And that's what you pay in, and you pay that which is due quarterly.
Okay.
And it's due by the last day of the month, the month following the end of the quarter.
All right.
So first quarter is due April 30th. It's the same time as the 941s.
That's a lot of information to process, and I'm sure our audience will have to spend some time with that. But what I want them to walk away with is this last question. What is the new hire report?
You have to, in Texas, you have to report a new hire. Well, you figure why? I mean, I'm paying him, right? Or her. What happens if they owe child support? The only way to find out is through reporting to the Texas Attorney General in the state of Texas, or whoever the child support collecting authority is in your state. You really want to do that, because not only is there a fine if they come back, but what happens to the other parent that's dependent on that support?
And that is so important. We have to continue that process. And I wanted to make sure everybody heard that. That document must be done in order for us to make sure our system is right. Make sure our children are taken care of. Craig, thank you so much. It's been such an opportunity to sit here with you today. I'm still excited. We've covered so much information, and I hope our audience got something from it. I'll be calling on you again soon. Have a great day. I'm Sharon Douglas, your host. Thank you for joining us. We hope you gained some valuable information today. Join us again on March 29th. And remember, ask me the question.